Welcome to Everything Money. Today we are talking about Marvell Technology. We will show you the financials behind this, not the Marvel movies, but we'll show you the financials behind this company and translate it into a stock price. We'll show you what you should be paying for this moving forward with our growth chart showing our stock analysis and stock analyzer tool. We will go to Mo, who might be trading Marvel. I'm surprised if you would be, but he'll show you the trends, the charts if you want to trade or day trade Marvel. And why should you be listening to us? I bring your questions about this technology company to a couple wealthy guys who manage over $100 million in real estate, stocks, and businesses. They will walk us through the process of looking at a balance sheet that is Marvell Technologies, where they're going, and what you should be paying. All this and more on Everything Money right now with Paul Gabriel. Go ahead, my friend.
Thank you, Seth. Follow us on Instagram. We have a new Instagram account.
Yes.
And then also follow us personally. That way you can see great pictures of our dogs. And, well, Mo doesn't have a dog. He just hates his girlfriend's dog. So, guys, this is our Everything Money software.
That's
true. I hope she doesn't watch this. Let's go to the 8 Pillars tool.
MRVL.
Marvell Technology. Boom. MRVL. So, guys, let's see how long these guys have been around. Okay. So this is one of the few companies that did a big boom in 2000 that have now surpassed their previous high. But as of the 2020 crash, they were still below their high. Okay. So this is a $60 billion company, guys. Our very first pillar that we look at of 8, very first one is we want a 5-year PE under 22.5. The 5-year PE is 233. And there was no PE last year. They lost $370 million last year. Oh, boys. Okay. Pillar number 2. We want the 5-year return on invested capital to be over 9%. Return on invested capital, ROIC, is how do they invest the money that is, how do they get a return on the money that's invested in the business through debt and equity? Okay. It is 3.2%. We want it over 9%.
Good boy.
Okay. We're off to a bad start. 2 X's. They have a dividend yield of 0.3%. Adorable. That pays out $170 million a year. So, guys, a lot of people look at dividends paid and look at earnings. I look at free cash flow. So on our software, we added the lines of free cash flow right here. That way you could compare it. So last year they paid out $170 million. Their average 5-year free cash flow is $475. Last year's free cash flow was $504. Now, Seth, here's the deal. Last year they showed a loss of $371 million, but they had free cash flow of $504 million. And they had consistent free cash flow of $475 million. So somebody's telling me there might have been a write-off last year. And their 5-year PE being 233 shows me they've made an average of $200 million a year in the last 5 years with a big write-off. Okay. So I'm not as concerned right now. I'm going to focus on the free cash flow. But let's go to pillar number 3, which is going to revenue growth. So we click on the income statement on our software. We go to 5 years ago. 2.37 billion. Last year, 3.46. Check mark there. But Seth, look at this.
Yeah, go ahead.
Look at 10 years ago.
3 billion.
Oh, wow.
3 billion.
They were falling.
Oh my gosh.
Guys, these guys were falling. So this is something we're going to look at. This is not a fast-growing company that 10 years... Now, did they sell off divisions? They could have sold off divisions. They could have bought some... I don't know what's happening, but this is why we do it this way.
6 months ago, they completed a $10 billion acquisition of Infi, expanding its data centers. They do circuits for data storage, networking, and communications. So they did just have a big acquisition, Paul. So let's check.
When does that close, though?
This says closing. Yeah, no, it says they did close on it 6 months ago, Paul. So we'll
really,
see
because
this.
I'm not seeing it in their. Because they're.
I was going to say in the free cash we would see this, right?
Yeah, I'm looking at free cash flow. They had a negative. Maybe they sold off a division as well. Because this is. Whoa, Jim Cramer.
Go ahead.
This might be net of something else, but I look at their history, and apart from last year, they don't have many acquisitions along the way, so we'll look into that. So, guys, pillar number 4 is net income growth. So you just want to see 5 years of net income growth. Well, it's going to be kind of hard. $264 million to a loss of $370.
Not growing.
Man, I don't like this. Look at all over the board here.
And during COVID, do I see a 1.4 billion?
Yeah, 1.4 billion.
And then it just went back to usual?
This is all over the board. So guys, when profit is all over the board, what do I want to do? I want to focus on longer term. Take longer term averages. Look at 5 and 7 year averages to apply. Because if you don't know 1 year is going to be a big loss or a big gain, doesn't mean you should ignore the company. There are companies like that. But that means you have to look at long term averages in more detail. Okay? Pillar number 5 is are they diluting their owners? Shares outstanding. Are they buying back shares or issuing more shares? Now, there's no set rule, but this is a very common misunderstood metric, but it's very important. You want to make sure you are not being diluted as an owner. What that means is if you own 10 shares out of 100, you own 10% of the business. But if they keep adding more shares, your 10 shares now are getting you less and less of the company. If they go to 150 shares, you still own 10. You went from 10% ownership to 6.6% ownership. They're diluting you. So go to the bottom of the income statement.
How bad?
500 million, 821 million.
Oh.
Guys, this is big time dilution. Now, it could have been because of this acquisition, but even before the acquisition, they were still issuing shares.
Oh, hell
What was it in 2012 there?
562 million.
Yeah,
Guys, I don't like this.
I don't either.
Well, they have grand projections. The CEO, they do cloud data, 5G, make up 54% of Marvel's serviceable address, but they're expected to go up to 63% in the next few years. They're going to get into China and offer some of their services. So they have, obviously, coming from their team, it's all roses.
I'm very, very surprised the CEO is optimistic about his business.
Yeah, usually,
right.
like, I used to run like a big company, and then I was just like, yeah, everything is just going to turn to you know what.
I was going to say, we should just spend a few hours watching the conference, listening to the conference call, and they'll tell us all the bad things.
There's something to be said for listening to those things,
Go on.
though. I do believe in listening to conference calls and talking to, but you want to see how they answer certain questions.
Correct. It's not the cheerleading behind it. It's how do they answer the questions of the relevant information.
Yes, it's
because
not-
they can project. Of course, they're going to project good things. Who's not going to project good things?
It's like if you went to your spouse and said, "Are you cheating on me?" If they went, "What? Cheating on you? What are you talking? I don't know what you're talking about. Like, why would you think that? You're so paranoid. You're cheating on them." But if they went to you and they, it's all about how somebody responds to things as well, right? So keep that in mind. Pillar number 6, though, to get back to it, long-term liabilities. Guys, that's the debt of the company. Just like you individually, companies that have less debt are going to survive much longer than companies with high debt. So how do we calculate a reasonable debt number? Well, I've come up with a method.
Yes.
Again, not set in stone, but I go to the main page. I look at the 5-year average free cash flow. I multiply it by 5. And in this situation, we get $2.4 billion roughly. $2.3 billion. $2.3 billion. 2.4. Darn, no, whatever. The bottom line is it's got to be around that number or lower. So we go to the balance sheet. Scroll up the balance sheet. Go to the very bottom.
The bottom line, you were saying.
Not the bottom line, but ooh,
yikes.
$5 billion.
Double?
Double. More than double.
That means it's going to take them over 10 years to pay down their debt. That's a lot. Like we looked at a company like Micron Technology.
Yeah, Micron.
It wasn't anywhere close to that. You know what I mean? You look at a company like Intel, it's not anywhere close to that. So companies in the same type of Cisco, they do a lot of data. That concerns me. So guys, the final 2 metrics are based on free cash flow. Okay, the first one is free cash flow growth, and free cash flow is cash from operations less your capital expenditures. And you can do 5 things with that free cash flow. Buy back shares, pay dividends, make acquisitions, pay down debt, and reinvest back in your own company. These are 5 things you can do. So these are very important. It's very important to look at the free cash flow. And your Uncle Paul here made it easy for you, added the free cash flow line right here to this financial statement. That we don't have to do the math. 436 to 504, that's a check mark. The free cash flow was much more consistent, guys. You see this? They only had 1 year of a loss of free cash flow in the last 10. So I'm going to focus on the free cash flow here on this company because it's a lot more consistent. I don't know what kind of shenanigans, but you still have to understand why the income statement is so up and down.
Right.
Final metric. Take the 5-year average free cash flow listed here, multiply it by 20.
Yeah, this gives us a desired market cap we might want to pay for this company.
9.5 billion.
I'm sorry?
9.5 billion.
Oh, Lord.
What's the actual cash market cap?
60 bill.
Guys, this is a massive X.
Jeez.
Massive X. Now, guys, just to show you, we make the data easy for you. We have the 8 pillars tab. You're probably gonna be like, why didn't you show us before? Because we want to teach you the process. Wow, look at these.
It's ugly.
UGLY.
Oh, hell
If you,
no.
Okay.
if you eliminate the crazy run up that has been since COVID, it's probably in that range. But
So, guys,
The stock analyzer tool is going to be pretty embarrassing for this
Yeah,
company.
it's
well, that's
gonna
why
be
we use
bad.
the stock analyzer tool next. It's going to say, okay, let's figure out what we should actually pay for this company. Now, so we created all of this because our users, our subscribers are saying, hey, how do we do our own analysis without waiting for you to make videos? Because it's not going to, there's 10,000 companies out there. We made the software. You get everything you've seen so far. You get everything that's coming in the coming soon section. All price doesn't go up. You get this all. You get it all on your mobile phone. You get access to Seth, Mo, and I. You get daily exclusive content just for users of the app and the website. And you get access to 6,000 other people. You get a community of people to discuss your investments with. Because if you're like us, we felt like we were on our own island until we created this, and all of a sudden a bunch of value investors started to show up. This is all for only 90 cents per day. 90 cents per day.
Check,
if you're
please.
able to make 1 or 2% extra a year because of this, over a long period of time, it could lead to hundreds of thousands and millions of dollars in your retirement for only 90 cents a day. No brainer. 2 ways to sign up. Everythingmoney.com and Patreon. The benefits of going directly to everythingmoney.com is you don't get double charged in the first month, and you don't pay sales tax yet because we're not big enough. So 90 cents a day. If you're serious, this is the way to do it. While I do the stock analyzer tool, do you want to go to Mo, or do you want to just go to the stock analyzer tool?
Well, walk us through this a bit. So the final stage, folks, is we haven't really mentioned the stock price at all. So what should we be paying? We can show you a tool that we use to project out as to what this thing could be and what we should be buying it today to make some money on it, Paul. You want a nice return. So
guys, the stock analyzer tool will tell us exactly what we want to pay based on our assumptions in the future. So guys, I go to the first thing here, years of analysis. You can pick 1 through 20. I pick 10 because the company's going to be around for a while. Number of assumptions, you can do 1, 2, or 3. I pick 3. Now here, guys, as you can see, there's a lot of assumptions here. I have to make these assumptions, and I'm going to go forward. The problem is, look at the 10 years of revenue growth, 0.5%.
so different. Yeah, so different from
0.5%.
So I'm going to go really low. I'm going to go 0, 3, and 6%. Profit margin, man, 6, 8, and 10, because there's a bad profit margin here. Free cash flow margin, much better, 12, 14, 16. PE, not a fast-growing company, a lot of unknowns. I'm going to go really low for both of these. Guys, this is going to be ugly. I'm going to go 10, 12, and 14 on the PEs and price of free cash flows. And the desired return, I'm going to do 12.5%. Now, why do we do 12.5% desired return? If you buy an ETF over long periods of time, you'll get 9 or 10%. So in order to buy an individual stock, I'm going to encourage you to get a return for that. Get a higher return, get 12.5%. We hit the analyze button. This is going to be bad.
Oh boy.
yeah. I mean, the market cap is
Does that say 2?
Yeah, this is bad.
so the actual price is $74.
Yeah, this is 72. I don't know what to say, guys.
The mid range is between $381 and $6.50.
And the reason being is it's this price of free cash flow plummet. It's selling for 118 times their free cash flow currently. That's a lot. That's a lot. That's a huge number. And when you take it down, you might sit there and say, well, Paul, let's put a lower number. Let's put a higher number in there. But guys, why would we pay a higher multiple for this company that's not growing?
And if you look at the history of the stock, it was never at these levels before. It took the biggest and fastest bull market ever to get it to these levels. So it does make sense that we're seeing those numbers coming from Stock Analyzer tool.
Yeah, so guys, I immediately go, not for me. We don't have to come back to me, not for me. I'm just ignoring it. There'll be better buys out there that can understand better. But trading the stock, that's what Mo does. He doesn't care at all about fundamentals, valuation, nothing. Mo, tell us what people are doing.
So I'm going to play a little Monday morning quarterback here. You could definitely have gone long on this, but I want to show you. So going long and going short from a charting perspective are virtually the same pattern. You're just flipping the chart upside down. So just like we moved through the sweet spot to the top side and it just went sideways for a long time as the stock price increased, maybe throw a tracker share on this thing and wait to short it, because this same thing is going to happen in the negative direction. This thing is going to come back to reality. It's just a matter of time. The stocks that have led this market up the highest over this run are going to be the ones to lead it down to the bottom. So pay attention to it. If you want to see it day to day, come over here to a daily chart. Once it breaks through all of these major moving averages, this thing's going down. I'm telling you that right now. So I think you should definitely keep this one on your watch list from a shorting perspective. And if you want to learn more about shorting, I have shorting seminars in the Bid and Ask Nation. You'll get access to that when you join.
This is far from super, Paul.
I'm just ignoring. Like I said, guys, there's 10,000 stocks out there. Find 20 to 40 that makes sense to you. Just move on from this one. Instead of worrying about why does it say 4 or 6, just move on. It just move on.
There's nothing to see here.
Folks, nothing to see here. Nothing to see here. This is like a car crash. You sit there and just keep barreling through.
That's our take on Marvel. Avoid the crash, and this one might crash down for sure. I mean, it's no way. It pretty much doesn't belong to be up this high, right? I mean, the
I mean,
ticker
I don't
price.
know. The thing is, it's just I'm looking at this price to free cash flow and going, this is not sustainable.
Yeah. Yeah.
I don't think even Tesla's is that bad.
And I
Yeah,
mean,
probably
when you
is.
see fluctuations like that, it's
It's tough.
That's our take. Tickle a thumbs up on the way out. We'll see you next video.